You know that obviously in 10 years, your customers aren't leaving because they're on contract. And then on renewal, aside from those two cases I just mentioned, they're renewing again. You have a 20-year-long relationship with a customer. How much leverage do you want to put on the business? You put as much as you can, right?
It's interesting because it's the way you state it now, it seems obvious that, hey, all you need to do is a matching exercise. Matching the contracts and the inflows with the leverage. So I guess two questions here. Why didn't other investors see this gap? Welcome back to Alpha Uncovered. Our guest today is a breakout Pan-Asia manager, Mr. Dale Zhang, founder and chief investment officer of Entrust Evergreen Partners, a Hong Kong-based manager who employs a concentrated private equity approach to public equities. With over a decade of experience in hedge funds and private equity, Dale has a distinctive yet familiar long-term investment philosophy centered on deep fundamental research and high conviction, concentrated portfolio of sustainable, durable businesses with strong moats and a long growth runway. His approach counters the increasingly short-term nature of public market investing, a trend that sacrifices the power of compounding, or what Dale calls the eighth wonder of the world. Dale was previously at Tricon, Jana Partners, and began his 12-year career at Credit Suisse, and is a fellow graduate of the Ivy Business School at Western University. Please welcome Dale Zhang. So Dale, it's really good to see you again, and thanks for coming by. We've had a couple of conversations over the last year about your newly launched fund, and you're what we call definitely an emerging manager. You just finished your first year of track, or coming close to the end of your first year of track. So for those of us who are meeting you for the first time, why don't you just give us a quick brief about your strategy and how you make money?
Alvin, really appreciate the time to come here and have this conversation as a follow-up for everything that we've done for the last couple of quarters and years. But I think the way to think about it, the genesis of Entrust is that we wanted to do something different here versus the other managers here in Asia. Look, we're not trying to be contrarian for contrarian's sake, but we like the term, we employ a private equity approach to public markets in Asia. So what does that mean essentially, right? Well, first of all, we want to be long-term investors. And you don't see a lot of that in Asia for a variety of reasons. And I'm sure we'll be going through those as we have our conversation. But long-termism matters and compounding matters. We always use a very simple example. If you had $100 in year one, you make 20%, that's $20. But if you compound that every year at 20%, in year 9, you're going from $500 to $600. That's 5 times as much money as you would have made in the first year, right? So for us, trying to find good businesses where we can actually piggyback off their success is paramount to our investing decision. The second part of this is, to do that, we want to be very concentrated. In our view, concentration actually benefits an investment firm because we're able to put more resources behind the idea. We're able to filter out businesses that do not fit our high hurdle. And ultimately, we're trying to avoid landmines. We're fundamental investors. And lastly, it's about turnover. We're a very low turnover fund. And actually, I was just reading up a statistic before having this conversation, but according to JP Morgan, over the last 20 years, so beginning of 2004 up to the end of 2023, if you were invested every day of the year, you would have made a return of about 9.9% CAGR, right? You take out the best 10 performing days, your return gets cut by more than half. You cut out 20 days, your returns is cut in half again, so a quarter from what you would have been if you were fully invested. If you cut out 35 of the best performing days, you would have lost money.
Wow. So that means that for most of the year, we're simply waiting.
That's exactly right.
For the 1 month in aggregate of actual performance in the market. That reminds me of something somebody said the other day, that time in the market is more important than timing the market.
That's exactly how we see it. Now, look, there's different ways to invest. There are people who are able to time the markets very well. We're not one of those guys. The way we think about it is we need to have conviction behind the businesses that we own. We invest with a business owner's mindset. And that comfort gives us the holding power to hold through volatility. And if we can do that, then we should be able to benefit on the upside.
So your fund is, I think it's quite timely because a lot of the funds that I interview here on this show are either very country-centric, right? They might be strategy-specific, meaning that it's very quant-focused. Strangely enough, your strategy is a bit of a combination of more vanilla, traditional style of almost like a Buffett style of investing, where you're taking a very long-term approach, but at the same time, you're not hitting one country. You're a pan-Asia strategy, right?
That's exactly right. We wanted to have a large playing ground for a variety of reasons. But the biggest one is that, again, since we're a concentrated fund, we roughly speaking have plus or minus 10 positions in the portfolio. We want the best ideas that we can hold for the longest amount of time, right? Going back to our point on compounding, avoiding landmines, etc. In Asia, there's just not that many ultra high quality companies we can do that with. It's a variety of reasons. Competitive intensity in Asia, especially in China, is just multiple folds that of the US. People burn money left and right. You have unaccountability of founders and managers. There's a lot of different places where you can lose money in the short term, and that's the things that we want to avoid. So having Pan-Asia as a sort of a hunting ground gives us that flexibility to find, in our view, the best businesses across Asia.
It's ironic because Asia and non-G7 typically is where 70% of global GDP is coming from.
Exactly, yeah. But we want to think about growth, right? So if you look at India, largest population country in the world, surpassing China, right? India's GDP growth is, call it 7 to 8% for the last decade. Now, China has slowed down, obviously. We're not getting the same 10% GDP growth over the last 30 years, but 5% on a much larger number, call it 120, 130 trillion RMB, on an absolute basis, still masks the growth rate or is the largest part of the growth rate in overall global GDP. So for us, being where the largest population is, being where the absolute growth numbers are, gives us, again, that flexibility to find good businesses that can effectively piggyback off that growth, right?
Okay. So first of all, I have to congratulate you. Your first year coming out of the gate has been really, really solid. Your team are definitely generating outsized returns, up well over 30 to 35%. At the time of recording, looking at Q3, you're roughly at 33%. I think YTD, you added a little bit over the top, maybe another 2 to 3%. So hopefully, I think we have 10 trading days, 10 trading days until the end of the year. So good luck with that.
Thank you.
So big focus in your fund naturally is going to be China and India, it sounds like. So why don't you give us Monday morning quarterback? How did the year look for you? I imagine Q3 was a good quarter for you.
Yeah.
But why don't you walk me through maybe just a brief P&L attribution analysis?
Absolutely. So for us, again, I'm going to start sounding like a broken record, right? We're fundamental guys. Yeah. We look for sustainable, durable businesses, and that's where we want to make most of our trends or alpha. So if you look at the breakdown of, call it 35% year to date, I would say half of that return is, or actually a little bit more than half, is attributable to the stocks that we picked. And it's very hard to parse apart attribution here, but what I would say is that the China stimulus, which is something we'll get into, I'm sure, in our conversation, that happened towards the end of September. So half of our returns happened by the end of August, right? So that is unrelated to the market. Actually, during that period of time, China was down.
Yeah.
And we were up, call it mid to high teens.
Interesting.
Right? And then from September onwards, a large part of that, fortunately, is beta, right? Our exposure to China, again, we're a Pan-Asia fund, but we saw a lot of bottom-up opportunities in China. We were 70% exposed to China. So that helped us in September, and that generated the other half of returns. Now, one thing I want to point out, though, we've seen the market in China fade from the start of October to today. And again, we're halfway through December. But if you look at our portfolio, we actually increased returns over Q4, or 2.5 months into Q4. And again, we attributed this to the good companies that we hold, and that over time, although this is a short period of time, people start to see the value, and actually these companies will outperform both in the short term and the long term.
Okay, so in short, you're outperforming the market when the market is either not recognized or back in August when the market had not really picked up on the stimulus announcement yet. And then now with the pullback, your book is still outperforming the market.
That's right.
Because you're clearly good stock pickers. This is what it's all
Look, we try to be. Again, right? What we tell our investors and we tell our friends here is that in the short term, look, we don't trade the markets.
So let's talk about sectors, themes.
Yep.
So let me tee it up for you. China historically has been a tech giant. It got hit pretty bad a couple of years ago with a regulation pushing back on the growth of these tech giants, and they've suffered a bit. Two ways investors could have played it: either put money back into a potential rebound in the biggest names,
Yep.
or maybe rotate into new segments which are not in the crosshairs of regulators, right? EV has done quite well, at least in the real terms. So what's been performing well in China in terms of sectors that you like that were outperforming? And then we'll talk about India afterwards.
It's a good question. Again, for us, we're trying to find bottoms-up ideas. And the ones that you mentioned, sort of the large tech names, we actually see those ideas being very saturated. Everybody that I know and their parents and their mothers are invested in looking at those stocks, right? So we find it hard to find an edge, and we can talk about what we define as our edge later. But for us, if I just look at the market cap of the businesses we own, our sweet spot is at $5 billion US.
Okay.
Right. That actually represents, I would say, the vast majority of our, roughly speaking, 10 companies in our portfolio. The reason we pick companies of this size, and it's partly due to automatically gravitating there and partly due to design, is that much smaller companies, say under $1 billion market cap, these companies haven't solidified their moat. We're very unsure whether or not these companies can last 3 to 5+ years. And the larger companies that I mentioned are too well covered, where people have parsed it inside out, and it's hard to find a differentiated view. So this is arguably our sweet spot here.
Okay. Now, and just to be clear for the audience, $5 billion in China, is that considered mid cap? Is that considered large cap? Where does that sit in the...
I think squarely in the mid cap space. It depends on, again, I think it's a good point you brought up China. If I look at ASEAN or I look at India, that's debatably on the larger side.
Yeah.
And our threshold for market cap on those regions is a bit smaller.
Okay.
But for China, we tend to skew mid cap, mostly because smaller businesses don't have that enduring moat.
Okay, got it.
On the sectors, it's not really the way we think about it, but I think this is a good segue into how we think about risk management. And the reason I say this is, although the next couple of things we're going to talk about is on the risk side, it actually, if you read between the lines, helps us figure out where we can make money, right? So let me list it off. We have our unique, we'll call it our 5-point risk management approach. So the first one is that we don't invest in cross-border businesses between China versus the developed world, right? Most notably the US. And obviously we've seen Trump's first term, which led to the trade wars. We've seen Biden put additional pressure on hard tech. And now Trump's coming in for his second term. So there's a lot of unknowns out there. Generally speaking, unknowns for us are bad. So we're avoiding the US, but we're also avoiding cross-border businesses between US tangents, such as the UK and such as Japan. The second thing we don't do is we generally don't invest behind state-owned enterprises. And again, for China, they're called SOEs. In India, they're called public service undertakings or PSUs. And for the rest of Asia, every different country has their own acronym for what a government-owned business is.
Well, why not? Because some would argue that SOEs is kind of safe money, right? That's where all the letter of credits are issued. And
It's true. It's one of those where it's safe until it's not.
right.
It's on the right side until it's not. And that's even taking a longer-term approach. And the shorter-term approach, shorter-term view is that you're not aligned, right? The money goes to the state. The state dictates what these companies can charge. Ultimately, we want to be in a business for its own merits, not because it's around, because the state deems
It's commercially driven rather than policy driven.
Exactly.
Because if it's commercially driven, then you're working for the shareholders, right? Your governance is for the shareholders. Yeah. And I guess your expenditures and your allocation policies are going to be more commercially minded.
That's exactly right. Capital allocation. We know that the margins and the cash flow generated will actually go to us as a minority shareholder. You don't have that certainty with the SOEs, right?
Okay.
The third one, and this is where it starts to get interesting, is that we only invest behind businesses that we see add real social value. And this is important because, again, a lot of the countries we invest in, the governments play a very heavy-handed role in dictating what is allowed, what isn't allowed. And it requires a lot of finesse to parse between the details. But if we know we're on the right side where the government wants to either stay neutral, which is great, or even want to promote it, even better, right? So a couple of examples that we can talk about here is the tourism sector in China. Tourism obviously is a private sector, but the government wants to expand domestic consumption in China. And we've seen the tourism sector flourish, even in a year like this year, 2024, when consumer discretionary purchases and consumer staples purchases even have come down and slowed.
Yeah.
The fourth one, the risk management approach, is coming down to...
Sorry, just going back to the social values, this feels more or less of risk management and sort of like your ethos or philosophy on investing,
Exactly.
right? Risk management, in my vernacular, is more about what do you do or break in case of emergency situations, right?
Yeah.
This is more of your approach to how the market and what to avoid, which in itself is risk management. So going back to the point about social value, I guess what you're saying is you're investing into commercially driven enterprises that are in line with government policies, though not controlled by government entities.
Or neutral.
Or neutral.
Right, but that's exactly right. It's interesting that you reframe this as sort of our ethos. This permeates what we do in the sense that we try not to be reactive. We try to be proactive. These are ways that for us, through our investing history, is a way for us to avoid landmines. We've seen if you're investing on the wrong side of social, you could have a good couple of years, but then you'd get hit. A good example of this, and I think people have parsed this through and through, is the education sector in China.
Yep.
It was a phenomenal place to be. There was a lot of growth potential and a lot of earnings potential, but sooner or later, the writing was on the wall. Education is a priority for the Chinese government in the sense that they need the cost to come down so the population would start having more kids. And China currently has a demographics issue.
Yeah.
So these are the areas where it may not be very apparent that you're going against the government, but by being in these markets, and I keep using China as an example because the government is very heavy-handed, you kind of figure out where you should be and where you shouldn't. So again, at a minimum, we want to be neutral. We don't need to invest with the tailwinds of the government, but we don't want to be hit on the head.
Yeah, it's ironic because you think that if education were more commercialized, you would have more competition and therefore drive down the price of it. You think that wouldn't be the case, but I guess they're uncomfortable with just the profitability, at least in the short term, of some of the new businesses that were coming out. Yeah, which is, I guess we'll never know how it would have looked like if more competition came to the market. Okay, great. So, and the fourth?
Going back to the fourth, we need to invest in businesses that can grow no matter where we are in the macroeconomic cycle. And this is purely out of cycles in Asia happen much more frequently than the US. I mean, in the US, we had GFC, and then 14 years later, we had 2021, 2022, right? The increase in rate hikes, right? In China, it's literally every 3 years.
Interesting.
Right. In India, we don't see it at the surface because the economy continues to grow. The stock market is a lot more nascent, but you still see underlying cycles in Southeast Asia and Japan, etc. So for us, there needs to be a market share gain story, some sort of pricing power story where even at the worst of times, you're not shrinking and you're growing. And this goes back to your point. It's more about an ethos rather than a real risk management approach. But this, for us, ensures that we don't have permanent impairments of capital. Again, we don't see risk as volatility. It's about losing money and unable to recuperate it for investors.
Okay. So going back to the first question, which is looking at your last 9 months, what were winning type of companies? Can you share with us a few cases of how, we understand that these are the parameters that you're looking to avoid and how to sidestep, I guess, number one, macro, number two, socio-political risks. So what came out from the filter?
Of course, the largest return today for us on a single position is GDS. GDS is a Chinese data center company. It was founded in 2003 and arguably the oldest and well-known wholesale hyperscale data center platform in China.
Wow, what does that mean, hyperscale?
So instead of renting out racks to retail clients, where people buy a couple racks at a time or is used for their small to medium-sized businesses, GDS is renting out full data warehouses for cloud service providers, right? The largest customer is Alibaba, and then followed by Huawei, Tencent, Baidu, etc. And these are the guys who are renting racks by the thousands and building out the whole cloud network in China.
Sounds like AI to me.
They get the benefit of AI without the risk, right? And arguably going forward, there's iteration, there's technological decay. You may need to keep building and keep buying new GPUs and CPUs, etc. Whereas GDS is just call it the warehouse, the physical infrastructure to house these cabinets and house these GPUs.
Got it. So do they invest into the GPUs themselves, or do the clients invest in them?
Only the clients. Okay. They take no technological risk.
Wow. That's amazing. So it's almost like physical logistics centers, except for semiconductors and GPUs.
So the easier way to think about what GDS is that it's a REIT provider, right? It's a technology REIT, and they're able to build these warehouses with the correct cooling, with the correct security for the cloud service providers to be comfortable and for their racks and their cabinets to run with optimal efficiency.
No, that's awesome.
So we got in this company right when we launched. Again, we thought there's a lot of value here. There's a significant margin of safety. The stock has come down significantly over the last couple of years because of a variety of concerns. And fast forward to today, the stock price has tripled. So we made 200% on this position. Now, obviously, when a position grows so much, it becomes a much larger part of the portfolio.
Yeah.
So we have rationalized the position considerably. But even today, it's one of our largest positions because we see GDS as still in the early innings of a recovery in itself. And also the whole cloud and data center sector is in its early innings in China.
Right.
And I think this is one where we can talk about how we would do our diligence and what separates us. Because the reason this opportunity came to be is that GDS is a highly levered business. Currently, it's at 8 times net debt to EBITDA.
Wow.
When you have such high leverage, there's always concerns whether or not this business can service its debt and or survive, right? Over the last couple of years in China, we have seen a slowdown in demand. We've seen an increase in supply from a lot of nascent, smaller players, which has put pressure on the whole data center sector, which has led to a lot of uncertainty in the average investor's view on GDS' ability to literally come out the other end. In our view, it's the exact opposite, right? And where we get our comfort is that we look at the contracts that GDS has with its customers.
Okay.
It's typically 10 years in length. And since GDS has been around close to 20 years, it's never had a real situation of churn. Now, obviously, customers churned over the years, but in our view, the correct reasons. And I'll give you 2 examples of this, right? The first example was when Uber churned out of GDS,
right?
And they left. Now, they paid a hefty fee for leaving, but the reason they left was that Uber consolidated its business with Didi, and Didi was the leading ride-hailing platform in China, and they merged the businesses together. Didi was already on GDS. So really, you can't say that's churn, right? It's a consolidation of 2 businesses already on the platform. The second example happened in just last year, 2023, where Kuaishou, which is a short-form video app competitor to ByteDance, they also churned off. Now, the specifics of it was that they've outgrown themselves. So instead of calling this real churn, they are evacuating or leaving one of GDS's sites and moving into a significantly larger site at GDS. Oh. And over time, they're actually going to double their capacity with GDS.
So that's really an upsell. It's not really a churn.
Exactly. So you take out these examples where at face value, yes, you're losing customers, right? So you're losing a renewal, but the reality of it is that you're not.
Yeah, it's an entry error more than anything else, or rather it's an accounting treatment. But in reality, these are customers that are still sticky.
Exactly.
The business is still with them at the, not just substantial, but the ultimate business is still with them in both cases.
So look, if you know that obviously in 10 years, your customers aren't leaving because they're on contract. And then on renewal, aside from those 2 cases I just mentioned, they're renewing again. You have a 20-year-long relationship with a customer. How much leverage do you want to put on the business? You put as much as you can, right?
It's interesting because it's the way you state it now, it seems obvious that, hey, all you need to do is a matching exercise. Matching the contracts and the inflows with the leverage. So I guess 2 questions here. Why didn't other investors see this gap? Is it because, did GDS open their books for you? Did they give you special access? Or Was it not covered in sell-side research, or?
It's a good question. And I think let me just nip this in the bud. We don't get any kind of different access to management.
No, I'm not suggesting
as we have, or as everybody else, right? Obviously, we want to be above board. No such, we're very cautious on MMPI, et cetera. So obviously, nothing like that. But what we try to do is really understand the business as if we were owners of the business, right? And it's funny you mentioned this because I had colleagues of mine in the US ask me, is GDS going to have a problem if US rates goes up, right? And this was in 2022-23. And 100% of their debt, aside from a convertible they have, is denominated in RMB. And they pay Chinese interest rates, which actually has been going down every year for the last X amount of years.
Yeah, I think it's interesting because a lot of the Western investors don't realize that China's actually started their deleveraging process earlier.
Very early, exactly.
Right? So actually, the U.S. was lagging on the rate increase, and they're also the first to start with the monetary easing as well. I think China is actually late coming out.
That's exactly right, yeah. I mean, if you look at GDS's interest rate, right, their net interest rate, it's actually been decreasing by about 100 basis points a year over the last 4 to 5 years. Mm-hmm. So I think, this goes back to my point, which is we want to be in a pond where not that many people are in. We want to be in sort of not that top layer of mega caps in Asia where everybody is trying to filter through everything, right? We want to look at companies where we can have edge because people just don't do the heavy lifting, which obviously we're happy to do.
When you look at, maybe I'll step back a little bit. I want to talk about China again, but how about the other countries, right?
Yeah.
We have India.
We have India, we have Japan, we have Southeast Asia.
Right.
I think every country has a different flavor to it. And one of the things that we should talk about is we wrote up one of our ideas in Japan.
Okay.
In our third quarter.
I'm glad you mentioned Japan because Japan is such a mixed bag.
It is.
And just to tee this off.
Okay.
Just to tee this off, I think it was the Buffett trade that started this. It was the anything but China or Taiwan trade. He came in, he flooded the market.
Yeah.
All the instos came in.
Yeah.
And so the large caps just went through the roof.
Gangbusters.
Right?
Yeah.
And so I now have allocators asking, what do we do now? Because the underlying economy is actually not doing as well as what the market is presenting.
Yeah.
Right. You have kind of a very mixed GDP. Investors are losing money on the FX.
Yes. Yeah. Quite significant.
Right?
There, yeah.
So how are you guys looking at Japan right now?
Again, Japan's interesting, and I'll give you sort of our highlights, right? I think everything that corporate Japan is doing with improving their price to book to over 1, the corporate shaming, the taking apart the entanglement of the company relationships there, being better capital allocators. I think these are all phenomenal things that as the right thing to do, and it really benefits us as investors. So don't get me wrong there. I think the issue that we're facing, I think is similar to some of the concerns you voiced, is there's some structural headwinds there that are not going away and are not improving. The biggest one is population, right? I was going to say population growth, but population decline. Right now, we're experiencing something like 50 basis points per year of population decline.
But that's true of China. It's true of Korea.
Yeah.
Right. So, why is this uniquely problematic with Japan?
But China is on the beginning of the curve. It's on the start of the curve, whereas Japan is actually accelerating the decline. So 50 basis points today translates into 70 basis points closer to 2030 and 100 basis points per year a couple years after that. That's significant decline in just overall demand in the country, right? And if you look at the current environment of inflation, a big part of that inflation is due to still the COVID hangover. It's the supply chain constraints, the logistic chain constraints from the COVID hangover. When that goes through the system and you still have this population decline, it's very hard to argue that Japan may go into a different environment where you see consistent and persistent inflation. So for us, well, those are the things we want to avoid, right?
It actually sounds like a case for shorting than it does for long.
Exactly. Look, well, this goes back to my initial point, which is we're not pessimistic on the country. We just think that there's issues that we need to circumnavigate to find good investments. Right. Maybe. So what do we have to do? We need to find a business where the underlying market at least is not shrinking, right? We need to find a business where it hasn't benefited from the depreciation of the yen over the last 2 years. And again, for our watchers here, the yen depreciated from about 115 on the dollar to about 153 today. right? That massively benefited exporters. So we want to steer away from that as well. Right?
We're actually waiting for BOJ to make a decision on
That's
race.
right.
Yeah.
This Thursday,
Yeah,
right?
Thursday, right,
Thursday,
yeah.
And then US is the day before. So there's a lot of uncertainty around the race, and we just want to avoid that in general, right? And the last thing we want is we want to find a business that has pricing power. Generally, good businesses have pricing power, right? Yeah. That's important. So in our sort of diligence, we found a business called USS. And USS is the largest and leading used car auto auction business in Japan.
Wow.
And to be clear, this is not your Sotheby's or Christie's where you're auctioning off, Aston Martins for tens of millions.
These are like Nissans and Hondas.
Or not even, exactly. Or even, in Japan, they call it the K cars, the mini cars, right?
Wow.
Your Daihatsus, your et cetera. That's what they do for a living. Right?
Interesting.
And what makes this business unique is that if you take a step
back... This is not a $5 billion market cap shop, though, is it?
It's a $4 billion.
Wow.
Well, it's because they have 40% market share, right? They're the largest players there, right? The next largest player is Toyota's in-house auto auction business at 13% market share. And the one smaller than that, the independent one, is at 6%, and then it trails off massively.
Holy cow, that's a market leader, right?
They're the market leader.
They outpaced the Toyota by 30%, almost 3 to 1, yeah.
Exactly, right? So then what does that mean? That means, and if you think about it, everybody talks about the flywheel. Everybody talks about the marketplace. Well, the auction house is the original marketplace. Size begets size. And that's what we've seen happen with USS. They continue to slowly grind up and gain market share. Because if you're a used car dealer and you need to go buy cars, you don't want to visit 4 to 5 auctions. You just go to USS. Right. And that the opposite is true too. If you're a dealer who can't get vehicle off your lot, you're not shopping this at 4 to 5 different auctions. You're going to the biggest auction.
So, but what's a growth opportunity at that point? It's a great business, obviously, but they're already a market leader.
Exactly. So let's go back to sort of our concerns, right? Used car market in terms of units in Japan is decreasing ever so slightly. And again, it's decreasing because the population is declining, right? But what makes up for this is the consistent and actually growing demand in exports. And I'm not just talking about the last 2 years where FX is incredibly favorable to purchase Japanese cars from abroad, but over the last 20 years, exports has been actually growing at, call it 100 to 200 basis points per year, right? It's accelerated over the last 2 years. So net, your total available market or addressable market for USS in terms of units has been flat. That concern is out the door. If you take a look at what they've done with their own business, is that they've consistently grown market share about 50 basis points a year. And again, this goes back to the marketplace, the flywheel effect, right? As they get bigger, they continue to grow and expand in size. And we continue to see that actually. On top of that, this is one of a few Japanese companies which has had pricing power and more importantly, utilized that pricing power. For the last 20 years, they've increased their per unit pricing by 1 to 2% per year. Reinforces that they have a real marketplace effect and that they are good stewards of capital.
I imagine, and this is going back to, apologize if I'm kind of putting a nail into this one, private equity approach to public equities. I'm thinking 3 to 5 baggers, which was the case in your first example, right, with GDS. With this company, you already had a market leader. It feels like it's close to saturation. Yes, it has incremental changes and increases in pricing power. Export hasn't hurt it as much as we thought it would.
Yep.
Where's the 3 to 5?
Yeah. So the way we think about this one, let me build up from the basics.
Okay.
Right? You have a market that's relatively flat. On top of that, you're gaining market share. On top of that, you have pricing power. On top of that, there's a couple new initiatives that they're doing, which helps juice up pricing a little bit more. Okay. Net, you're not getting 20% top line growth. Right. Realistically, you're getting something like mid-single to high single digit top line growth. Okay. Not that exciting for now. Then you move down the income statement. They continue to see margin expansion for the business model. Again, a lot of that comes from the pricing power they have. So ultimately, at a net income level, you're growing closer to high single digit to that 10% area, right? So again, incrementally better, but we haven't reached a certain scale. What makes us interesting from a shareholder's perspective is that this is a management team that is incredibly focused on capital allocation, return on invested capital, and total shareholder returns. As we talked about over the last 2 years, Corporate Japan has been very focused on share buybacks, putting out a dividend, having the right capital structure, etc. USS's management team has been doing that since inception and since their IPO in 1999. So 2 concrete examples for this. They've increased their dividend every year for the last 25 years since IPO.
Wow.
In addition to that, they have done share repurchases whenever their stock has been cheap for the last 20 years. Wow. Every slide they have in their presentation, they talk about return on invested capital and the hurdles and the targets they're trying to have. So if you add on the dividends, you add on the share repurchases, now you're getting somewhere in that mid-teens total shareholder return growth rate. So we're getting to the lower end of what we see as an acceptable return for investing in Asia.
Yeah, so if I put my intern hat more on the dividend distribution model, more than the cap-in kind of approach.
Exactly.
And number 2 is, it sounds like they're monetizing the market share. At least they're in the phase of monetizing the market share.
They're actually looking to increase their market share. Over the last couple of years, market share has slowed down. Market share gains have slowed down. And they're going to expand 3 of their largest facilities. The largest one in Tokyo, Yokohama, and Osaka. And just to give you a sense of scale, its Tokyo facility every week auctions off 14,000 cars. Just the Tokyo facility itself represents close to mid-teens of the total Japanese used car market auction. And it's still growing.
Wow.
That's how important it is of an institution for the industry and the opportunity for that to continue to scale.
And who's buying these used cars? It's just generally the dynamic of the population is shifting into used cars versus new car sales?
No, this is the used car dealers. So the whole used car environment in Japan, roughly speaking, about 7 million units exchange hands versus new cars around 4 million units.
Got it.
And it's just the buying and selling of people trying to switch cars. Maybe they're bored of one car, want to get into another. As cars get older, they get shipped off overseas and people get into new cars.
Got it.
And actually, this is why this opportunity exists and we see margin of safety today, is because over 2023, especially in the back half, you had a lot of new car dealers in Japan having regulatory and licensing issues. Basically, they were skirting around the emission standards. And we saw that in the US, we saw that in Europe. And this came to light in Japan at the end of last year. That continued all the way throughout this year. So even the likes of Toyota, Honda, Nissan, all of them had to recertify a large part of their production marks and their production vehicles, artificially depressing new car sales. Well, if a person's not getting into a new car, they're not trading their used car. So you have this artificially weak used car volume for this year relative to what we call normalized volume. We're starting to see these certifications finally get passed and roll through. So new car volumes are coming back up. And by definition, used car volumes will increase as well. So you are in this, I would call this a one-time depression of new car sales, which led to a depression in used car sales, which led to a depression in USS valuations. So we're getting in actually at trough valuations, under 10 times forward EBITDA, whereas this company typically trades around 12.5. So again, we don't underwrite to margin expansion. We focus on compounding of earnings power or normalized earnings power, but any kind of kick on valuation is very helpful.
So when you look at companies like this, like you say, don't focus on margin compression, you look at compounding, which normally takes at least a medium-term approach. So we're talking about 3 years.
At least. Yeah.
Right. Your fund is highly concentrated. It's a long only. How do you manage expectations for investors coming in at different points of the investment cycle? Because this is your first year. You've built your 10 positions. They're baked in. You're looking at compounding. Investors on day one, they're probably going to see some great returns. How do you manage expectations for investors coming in on day 20, on day 30?
Yeah, I think that comes full circle to the first question you asked about how we think about running the fund. And my response, if I remember from an hour ago, is not a lot of people do what we do out here. And for a variety of reasons, but let's build up the foundation, right? The building blocks. You have very volatile markets. Because you have very volatile markets, you have nascent investors or LPs who are very scared of the markets as well. And because you have more shorter term viewed LPs, because again, they see the volatility of the markets, you now have volatile managers. And these volatile managers will trade in and out of stocks, missing those 10 good days that gets you that long-term return profile, as I mentioned from the JP Morgan study, that leads to higher churn on the stocks, right? So for us, our whole foundation is built upon having the right investor base. And that's what we have. Our investor base understand we're in it for the long term, right? So it implores them to be in it for the long term as well. Now, obviously, our day one investors have benefited from the success of this year, but we see the setup every year going forward. Obviously, it's very hard to achieve 30% plus returns every year. The direction of what we're trying to achieve is there. The proof of concept that we can outperform the market because we have better businesses is there. And hopefully they'll give us that leeway whenever we do underperform. Right?
That's fair.
But having that kind of investor base allows us to have that long-term thinking where we don't have to worry about short-term volatility. It gives us that clarity of mind so we can make the right decisions that would, again, benefit our investors for the day two investors, the day three investors, because we have that right mindset no matter where the investor enters. And what we say is that we can outperform the market across business cycles, so 3 to 5 plus years. And the right investor base will sort of gravitate towards that. And selfishly speaking, it helps us filter through the guys who are much more short-term focused.
Okay, so you've spent the last year building a book. Let's now talk about two things. What keeps you awake, either from a macro level or from your book level? And number two is what's exciting you or where's exciting you for 2025?
We stay awake for a variety of reasons. What keeps me up, I would say the number one question I keep asking myself is, am I wrong? And when the market moves against you, I think the inclination is always to do something. I think that's just human nature. But at one point, you need to balance the humility to say, hey, look, we're definitely wrong. We made a mistake. We'll take the loss, but that preserves the rest of the capital. Versus the other side is the market is wrong. We've done a lot of work. We know why the market is wrong. And we're going to double down. And it's always really hard to parse between the two as an investor. But I think this is really what separates the good from the great, right? And this is an area that we're always learning. So I'll give you a good example of this. Our biggest loser year to date, this was end of June. So biggest loser in the first half was a company called Freshworks. It's an Indian-founded business, and recently in 2021 IPO'd in the US, and since then moved the headquarters from Chennai, India to San Mateo in California.
Okay.
This business, we see it as the most successful and leading challenger in the IT service management B2B software space. They are arguably the only cloud native player and are nipping at the heels of the largest player called ServiceNow, which is trading at 17 times revenue, the behemoth in the industry. And these guys trade, when we entered, closer to 4.5, 5 times revenue. Now, there's many reasons it's trading at that kind of discount, but I'm giving you the general summary. Well, since we got into the stock declined 40%. Obviously, with a concentrated book, this is a meaningful hit on our portfolio. Well, when a stock's down 40%, we need to make a decision whether or not to double down or not, right? Because typically speaking, if you're down so much, it means some people don't believe there's a viable business effectively that's public. So obviously, before getting into position, we've done everything that we could, right? We did a bunch of work from the outside in as public market investors. We read everything that's available. We talk to management team. In addition, we talk to all the competitors, their customers, etc. And from the what we call inside out work, I've tried all their products. I've been pitched all their products. I've gone to pitches from my colleagues' businesses for these products. I understand what they offer separate versus what other competitors are offering. And it is a good product. So what do? We re-underwrote the position and we actually doubled the position size after it was down 40%. So since then, fast forward to today, the stock from its lows was up close to 50%. And because we've doubled down at a much lower price point, we actually are exactly at break even on this position now.
Yes.
I think this is an example of something that has worked out, right? Because we understood the business in our view better than the short-term views people had around the macro environment, that revenue growth was slowing, etc. But these are the situations that keeps us up at night, where we do exhibit significant volatility on a single position. How do we manage that position, and do we ultimately make the right decision? From an opportunity set today, we always think Asia is rife with opportunity, right? But if I look at the hunting grounds today and how our portfolio is set up today, we still have over 60% exposure to China. So obviously, we're voting with our feet. We think China is at the perfect setup going into next year, and our companies are in a perfect position to benefit from that. In the second half of this year, we saw the third plenum, which China came out indicating there's massive structural reforms that they want to implement. I won't go into the details, but we talk about it a lot more in our third quarter letter if anyone's interested. And more recently, with the Central Economics Work Conference that actually just came out last week, they've doubled down and they were very aggressive in both the verbiage and tone that they're going to turn around China, turn around consumption spending, rebuild consumer confidence in fundamentals and the stock market, and stabilize the property market.
There seems to be a number that the market is very focused on. I think it's at $10 trillion is what everybody expected to see.
Round number.
I wanted to see 10 trillion, and there seemed to be some disappointment in the first announcement back in September after the bump.
Yep.
And there seems to be some more encouragement in the last week after the more fiscal spending policies were being released.
Yeah.
But what's your view on this? Is the market right to feel disappointed in these policies, or is there a mismatch?
It's a very interesting question. Look, our view is that this number honestly does not matter, for a variety of reasons, but let me give you some examples here, right? Everybody is focused on a number pulled out of thin air, but the reality is there's steps that needs to be taken for people to start spending more, right? This one-time hit or one-time subsidy and benefit is going to be exactly that, a one-time bump. You're not going to reinstill consumer confidence by doing that. But what does reinstill consumer confidence? The government coming out, continually making reforms, reaffirming that they're going to fix the economy. Over time, that should have dividends. Let me give you the easiest way to interpret this, right? If you look at what the Chinese government has done for decade, 2 decades, etc., they have always done what they said publicly and announced publicly. So it's never a matter of if, it's a matter of when they'll do it, right? Even announcements they've made that the market has took very negatively, they still follow through with it. So why is that not the case on the other way around, right? If you look at the consumer in China, the consumer is actually in really good shape. So to give you, again, some numbers here, let's take the last 5 to 8 years from 2018 to today. Actually, every year, consumer wealth per capita has increased, even though the property market is down anywhere from 30 to 40%.
Okay, how does that math work out?
The savings.
Right.
Consumers are spending less. There's over 150 trillion RMB in the consumer's bank account.
Wow.
They are in a very, very comfortable net worth, net asset position.
And how's that compared to the debt that's on the real estate side of the book? So real estate, I think it's 150 trillion in savings. I think the real estate is like a quarter of that.
What I'm looking at is actually net real estate wealth.
So net of real estate wealth.
Net of the mortgages, the equity value is now, roughly speaking, it's obviously come down, right? It used to be a little over 60% of household net worth. Like, now 40? It's a little over 40%.
Yeah. It's still monstrous compared to any other country.
Exactly. But what made up the rest is savings. So net consumers actually have higher net worth today than a year ago, 2 years ago, 3 years ago. Right. So all you need is to instill confidence for them to spend again. So to give you an example of this, Shanghai recently has done 2 rounds of subsidies totaling 500 million RMB. These subsidies were very well crafted, but very specifically targeted to consumption and spending within the localities. This has led to more than a 5 to 6 times increase in spending per dollar of subsidies provided.
Wow.
Right. So dining coupons. Right. For every dollar of dining coupons, the average person spent 5 to 6 RMB. Right.
Right.
So effectively, they're using this as a poster child or as an example of how to smartly distribute subsidies and not just have a headline number.
Right. Targeted rather than broad-based, yeah.
Exactly. Yeah. And then look, everybody's talking about this 10 trillion number, but let's see what the government has done, right? They have announced at the CWC that they're going to increase the fiscal deficit, right? The fiscal deficit was around 3% for 2024. Next year, currently the expectation around 4 to 4.5.
Okay.
That's a little over $1 trillion, right? They're going to cut the reserve ratio for banks by 50 basis points. That's another $1 trillion. They said they're going to issue more special purpose bonds and long-term special treasury bonds. Those in total for 2024 was 4.9 trillion. So maybe you have another trillion on top of that. Well, that's already 3 trillion to your 10
We're
trillion
almost
mark,
there.
right? Yeah, exactly. Right.
I think people are kind of like expecting some type of like Inflation Reduction Act where you just completely blow away the market with literally actual $10 trillion hitting the market at one time.
We've seen that actually leads to significant issues like back in 2015. So the government's never going to do that. But each targeted approach sooner or later adds up. Right? And we're starting to see consumer confidence come back. Again, nothing comes back overnight. You don't announce a stimulus and the week after people are spending like they were back in the heydays, like 2018, right? But we've seen retail sales gradually improve. I wouldn't say a stabilization in real estate markets yet, but we've seen a direction to get there. Those are the two biggest things that China has to figure out, right? So we're confident it'll happen. It's just when.
Yeah, it's like both Western managers, investors, and even a lot of local managers who got burnt the last 2 years. There's a lot of salt.
I believe that.
There's a lot of salt. Paradigm shift in China. We don't believe in what they say anymore. But you're right. If you look at it, they've done exactly what they said they were doing. 4 years of deleveraging. Now they're moving into monetary easing. Sure, you can nickel and dime it, but at the end of the day, they're moving in the direction that they said they are.
That's exactly right. Look, and that's why we're very positive on China. Look, it doesn't mean we're not positive on India and Japan. I mean, we focused our conversation predominantly on China because that's what people are interested in right now, right? And this is where the value is, right? The value is not in India today, where you're trading at all-time high multiples and underlying consumption demand is actually getting weaker. We're excited about India for the long term, but we still need to find the right place and the right time to get into these positions, right? So from that perspective, our portfolio is positioned to benefit from China, but the amount of work we're doing is actually outside China in other regions where we think, okay, if something happens, if we get the right valuation, we'll plow into that fundamental idea.
Thank you so much for coming down.
I appreciate the time, Alvin.
Congratulations again.
Thank you.
We'll see you in a couple of quarters.
That sounds good. Okay.